Welcome to The Debate. Today, we are opening up the hood on a company that is currently undergoing what I would call open heart surgery while simultaneously trying to run a marathon. We are looking at the Jetcon Corporation Limited Annual Report for 2024.
Right.
This is a 30-year-old staple of the Jamaican automotive scene, and they have decided to essentially burn the boats. They are completely pivoting from the used car dealership model that built them to become a distributor of new vehicles, specifically the Chinese brand BAIC, and somewhat surprisingly, a solar energy provider.
Yeah, well, I have to say burn the boats is a very generous way to describe it. I might say they are burning the furniture just to keep the lights on. Because this report forces us to ask a pretty brutal question. Does this 2024 document actually depict a visionary company executing a painful but necessary strategic metamorphosis? Or, do the collapsing margins and the massive operating losses signal a business in existential distress?
It is the classic tension between strategy and survival, and I am here to represent the view that the losses we see, and they are ugly, I am not going to hide that, are a calculated, temporary purchase price for a future that is much more lucrative. This is a company shifting gears, to borrow the chairman's own phrase. They are backed by incredibly strong asset values, and they are entering verticals with actual, tangible growth potential.
And I represent the view that strategy is very often used as a shield for operational failure. The fundamentals here, specifically a really catastrophic drop in gross margins and a reliance on property revaluations to mask the fact that they are just bleeding cash, indicate a failing business model. We aren't just looking at a transition year here. We are looking at a financial freefall.
I mean, a free fall implies that gravity's the only thing working. Jetcon has a flight plan. But let's start with the elephant in the room, the financials.
Let's do that, because the numbers are stark.
They are. But to really understand 2024, you cannot just look at the bottom line and scream fire. You have to look at the intent behind it. The executive chairman, Andrew B. Jackson, is very explicit in his report. He frames 2024 as the year Jetcon, quote, shifted gears to move on up from used to new. They made a deliberate, board-level choice to exit the used car market. The management discussion and analysis states clearly that the used car sector was becoming less lucrative.
Well, less lucrative is the understatement of the century. Let's actually look at the cost of that decision. You say it was deliberate. I say it was ruinous. Jetcon posted a net loss of $74.3 million in 2024. For context, in 2023, they lost $4.5 million. That is a deterioration of over 1,500%. You don't just shrug that off as shifting gears. That is stripping the gears entirely.
But you have to ask why the loss happened. It wasn't because nobody walked into the dealership. It was because to fund this pivot to physically buy the new bike inventory without taking on massive, crippling debt at 8 or 9% interest, they had to liquidate the old used car stock. They sold it at competitive prices and, yes, often at or below cost.
Right, and that leads to the metric that actually scares me the most in this entire report, the gross profit margin. This is the heartbeat of any retail business. It tells you if you're actually adding value to the product you sell. In 2022, which was a relatively normal year, they were at a healthy 13.6%. In 2024, that collapsed to 4.1%.
Which is exactly what happens during a liquidation event.
But think about what 4.1% means practically. For every $100 they bring in revenue, they only keep $4.10 to pay for salaries, electricity, marketing, rent, and administration. You cannot run a dealership on 4% gross margins. It is mathematically impossible. And the kicker is, while their revenue dropped nearly 23% to about $520 million, their administrative expenses actually increased to over $120 million. So they are selling less, they are making almost zero profit on what they sell, and they are spending more money to do it. That is a death spiral.
Okay, I see why you frame it that way, but you are treating that 4.1% as if it is their new normal. It is not. It is a one-time anomaly caused by the strategic decision to clear the deck.
If you are intentionally selling a 2018 Toyota Vitz at cost just to get the cash out of the metal, your margin is zero, but once that car is gone, it is gone. You don't sell it at a loss twice.
But you have to survive long enough to sell something else.
And they have. This is the liquidity argument that I think you are missing in your analysis. Look at the liquidity and capital resources section of the report. Management explicitly notes that they funded this entire transformation, buying the new fleet, refitting the showroom, through cash flow generated by operations. They did not use their overdraft facility.
Which is a miracle, honestly.
No, it is discipline. In a high-interest rate environment, where borrowing costs would have just eaten them alive, they chose to take the hit on the income statement to protect the balance sheet. They avoided leverage. That is a sign of a management team that is looking at the long game, not just trying to make the quarterly numbers look pretty for the market.
I interpret that very, very differently. I don't see that as discipline. I see it as desperation. You can only sell the furniture to pay the rent for so long. The used car segment was their bread and butter for 30 years. It provided the reliable cash flow that kept the lights on. They have now abandoned it for a segment new cars where they currently have negative operating margins. Look, they generated $21.48 million in gross profit, but their expenses were over $100 million. That gap is massive. They moved from an operating profit of $34 million in 2022 to an operating loss of $72.4 million in 2024.
But the bread and butter was going stale. That is the whole point of the pivot. The used car market in Jamaica has become commoditized, it's saturated, and margins were compressing anyway. Staying there was a slow death. Moving to new cars is a risk, yes, but it is a shot at life.
Okay, so let's talk about that shot at life, the BAIC bet. Because if they burn the used car bridge, this new Chinese bridge better be made of steel.
It is stronger than you think. This isn't just about swapping one car for another on the lot. It is about moving up the value chain to become a distributor, not just a reseller. The report of directors makes a really interesting observation here. They note that customers are becoming less resistant to Chinese versus the usual Japanese-made cars. This is a global macro trend. The quality gap has closed.
The quality gap may have closed somewhat, but the brand equity gap is still the size of the Pacific Ocean.
It is closing fast, and there is a geopolitical tailwind here that I find genuinely fascinating. The report calls it the Trump factor.
Yeah, I saw that. It seemed like a bit of a reach to me.
I don't think so at all. The report suggests that with brewing U.S.-China trade tensions and potential tariffs, Chinese manufacturers are going to be squeezed out of the U.S. or face massive barriers. That motivates them to look for friendly, non-U.S. markets to dump supply and build relationships. The Caribbean is perfect for that. Jetcon argues this could offer positive spin-offs for Jamaica. They could get better pricing, priority shipping, and better terms because BAIC needs this market more than Toyota does.
That is an incredibly speculative geopolitical bank shot. You are basing your business model on the hope that a trade war drives Beijing into your arms. It feels like trying to find a silver lining in a hurricane. And speaking of hurricanes, let's actually look at the risks. Management is unusually candid in the risk section. They admit, and I quote, "At the moment, we cannot do anything to prepare for any potential fallout or sanctions that could emerge."
Every business has geopolitical risk.
Not like this. Most dealerships have a diversified supply chain. If Toyota has a recall, you sell Hondas. If Honda has a supply issue, you sell Suzukis. Jetcon has bet the entire farm on a single Chinese supplier. If sanctions hit back, or if shipping lanes are disrupted by a conflict, Jetcon has zero inventory. They have introduced a massive single point of failure into their business model.
But if the risk doesn't materialize, they have exclusivity. They are the only ones selling the X55, which is their best seller. They have the BJ40, which is a legitimate competitor in the off-road space. They are bringing in the X35 and the BJ30. They are building a full catalog of SUVs, which is exactly what the market wants right now.
Let's look at the market demand then. The proof is in the pudding, or in this case, the sales figures. How many of these highly in-demand vehicles did they actually sell in 2024?
They sold 26 units.
Which is up from 4 in 2023.
26 cars.
In a full year. And based on that tiny sample size, they're projecting 250 sales for 2025.
It is a pilot program ramping up.
That is a 10x increase. In any statistics class, that is called an unsupportable extrapolation. You cannot take a data point of 26 and draw a straight line to 250 without a massive change in your variables.
But the variables have changed. They opened the new showroom late in the year. The marketing machine is just turning on. The brand awareness is just starting to percolate in the consumer base. And remember, 26 cars was during the transition chaos. Now they are completely focused.
I just don't see how you scale administrative costs to support a new card distributor model on the volume of a boutique hobby shop. 26 cars is 2 cars a month. You literally have more staff than customers.
Which is why they aren't just a car company anymore. We have to talk about the diversification, the solar division.
Ah, yes, the hidden gem.
It is a gem. Solar revenue reached $57.2 million. That is 11% of their total revenue. The report highlights that demand spiked 67% in the latter months of the year. This proves Jetcon is successfully diversifying into a multi-brand retailer of energy and transportation. If the car market is soft, the energy market picks up. It is a classic hedge.
I have looked at those solar numbers, and I would frame it very differently. The report explicitly states that solar sales were basically flat, averaging about $3.2 million a month until Hurricane Beryl hit. The spike wasn't a strategic marketing win. It was disaster-driven demand.
That is what a business does. It responds to market needs.
But relying on hurricanes to drive revenue growth is not a sustainable business model. Unless they plan on seeding clouds, they cannot count on that 67% spike repeating next year. And let's just do the basic math here. $57 million in solar revenue, not profit, revenue, is a drop in the bucket compared to the hole in the auto division. If they make a 20% margin on solar, that is maybe $11 million in gross profit. They lost $74 million. Solar is a nice side hustle, but it is not a structural solution to the collapse of their core business.
I think collapse is hyperbole. And this is exactly where we have to look at the balance sheet, because if this company were truly in a debt spiral, you would see their equity shrinking. You would see assets being sold off to pay debt. Instead, what do we actually see? Shareholders' equity increased to $734.9 million. Total assets are up to $831.5 million.
This is the most dangerous part of the report, in my opinion.
How is having nearly $1 billion in assets dangerous?
Because it creates a completely false sense of security. We have to distinguish between paper profits and operational reality. Where did that equity increase actually come from? It didn't come from selling cars. It didn't come from selling solar panels.
It came from asset appreciation.
Exactly. The report shows a massive swing to a positive $101.4 million in total comprehensive income. But if you read the fine print, that is entirely 100% due to the revaluation of their 3 real estate properties. They hired a surveyor who said, hey, your land is worth more now. That goes onto the books as income.
But it is real value. Real estate in Jamaica is a highly solid asset.
It is real value, but it is not liquid value. You cannot pay your staff with higher property values. You cannot pay back for new cars with a revaluation surplus. Cash is oxygen for a business. Property value is just furniture. And the absolute giveaway that this is just paper profit, is the dividend. Did the directors recommend a dividend for 2024?
No, they did not.
Exactly. A company that claims to have $101 million in comprehensive income pays a dividend. A company that actually lost $74 million in cash does not. They are asset-rich and cash poor.
I disagree with the complete dismissal of the asset base. That asset base is what gives them the runway to pull this off. It signals to lenders and suppliers that Jetcon is solvent. The report specifically mentions that supplier confidence improved and they benefited from extended credit terms. Why? Because suppliers looked at the balance sheet and saw $831 million in assets. They know Jetcon is good for it. That revaluation isn't just vanity. It is collateral. It is a safety net.
Or it confirms that Jetcon is essentially a real estate holding company pretending to be a car dealership. If you strip out the property revaluation, the operational reality is a disaster. The revaluation is a financial band-aid covering a deep operational wound. And eventually, if you don't fix the wound, the patient dies, and the bank takes the real estate anyway.
But the wound is healing. That is my whole point. The wound was the used car inventory. It is gone now. They have cauterized it. Now they are in the rehabilitation phase. Andrew B. Jackson has navigated this company for 30 years. He founded it in 1994. He has seen downturns before. The shift to BAIC is not a whim. It is a calculated bet that the Jamaican consumer wants value and style, and that the Chinese auto industry is the future.
Betting on the future is expensive, and they are running out of chips. Let's look at the overhead again. Administrative expenses went up. Why? Because selling new cars requires a completely different level of polish. You need a nicer showroom, better-dressed salespeople, more marketing, dedicated warranty departments. They are carrying the cost structure of a major dealership like Toyota Jamaica, but they have the sales volume of a neighborhood lot.
That is simply the cost of entry. You can't sell brand new cars from a dirt lot. You have to build the infrastructure first, and the sales follow. It is a J-curve. You go down before you go up.
My fear is that the J stands for just about over. New car margins are notoriously tight, often tighter than used cars because the manufacturer dictates the price ceilings. They are entering a space with established titans, Toyota, Honda, Suzuki, who have massive scale. Jetcon is trying to fight giants with a brand that, while improving, is still relatively unknown to the average buyer.
That is where the Jetcon way comes in. They are known for customer service. They are known for being agile. The big giants are slow to adapt. Jetcon can pivot. They can offer better financing terms. They can bundle solar chargers with the electric vehicles they bring in. They have synergy that the others just don't have.
Synergy doesn't pay the light bill. Cash does. And right now, their operations are consuming cash, not generating it.
But they have the runway to fix it. That is what the assets provide: time. They have bought themselves time to let the BAIC brand take root. If they hit that 250-car target in 2025, the narrative flips completely. Suddenly, they are the premier distributor of the next wave of automotive technology in Jamaica. The margins stabilize, the service department starts making money on the new fleet, and the solar division keeps growing.
IF is doing a lot of heavy lifting there. 250 cars is a massive number for them. That is almost a car every single working day. They are currently doing one every 2 weeks.
Momentum builds. And remember, the economy is shifting. Interest rates are expected to soften. That brings buyers back into the market. Jetcon is positioned perfectly to catch that rebound with fresh, affordable inventory, while their competitors are still trying to offload expensive Japanese stock.
Or rates stay high. The Trump factor leads to harsh sanctions on Chinese tech, and Jetcon is left with a showroom full of unsellable cars and a massive overhead bill.
Let's bring this to a close. We are looking at the exact same picture, but seeing two very different movies. When I look at the 2024 annual report, I see a company in the middle of a brave metamorphosis. Yes, the P&L is ugly right now, I grant you that. But they have preserved their cash by not borrowing, they have secured a new international partner in BAIC, and they have maintained a massive asset base that keeps them stable. The Jetcon way has worked for 30 years. I believe the projected 250 car sales in 2025 will vindicate the painful decisions of 2024. They are shifting gears, and the clutch always slips a little, and maybe smells a little burnt, when you change speeds aggressively.
And when I look at this report, I see a company that is currently bleeding out operationally. You talk about shifting gears. I am worried the transmission has dropped out of the bottom of the car. A 4.1% gross margin is unsustainable, full stop. The pivot to Chinese cars is unproven at the scale they need to survive. I view the property revaluation as a distraction, a fresh coat of paint on a house that is structurally unsound.
Well, we can certainly agree on one thing. 2025 is the year. There's no hiding place in the next report.
Absolutely. 2025 is the make or break year. If those 250 sales materialize, you might be right, and I will happily eat my words. But if they sell another 26 or even 50, the assets will eventually have to be sold to cover the losses. And then there is no company left.
For our listeners, we highly encourage you to open the report and look at the 10-year historical financial data yourselves. Don't just take our word for it. Look at the trend lines. Look at the asset growth versus the profit decline. Decide if you see a pivot or a plummet.
It is a fascinating document, a roadmap of ambition or a warning sign. Only time and the 2025 sales figures will tell.
Thanks for joining us today on The Debate.